Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and as always, I'm joined by Lana Chen. Lana, I've been staring at this one for a few days now, and I think it's one of the cleanest industrial setups on the board.
That's a teaser of an open. Which one?
Eaton, ticker ETN. It's a power management company sitting in the middle of three massive tailwinds at once: AI data centers, grid reinvestment, and electrification. The stock has basically doubled over the past 2 years, and the backlog keeps setting records.
And yet nobody ever calls Eaton a glamour stock. It's switchgear and transformers, boring, quietly essential, and suddenly extremely in demand. Let's unpack it.
So let's start with the basics. Eaton is headquartered in Dublin, Ireland, an Irish-domiciled company with most of its real operations still run out of Ohio, which is where it was founded back in 1911. About 94,000 employees globally, across roughly 175 countries.
And the business is organized around two big groupings: electrical, which is the growth engine, and industrial, which covers aerospace, vehicle, and e-mobility. Electrical is split further into Electrical Americas and Electrical Global, and Electrical Americas is the crown jewel.
What do they actually make? Think circuit breakers, switchgear, uninterruptible power supplies, power distribution units, transformers, hazardous duty equipment for oil and gas, and the control systems that tie it all together. If a building, a factory, a data center, or a utility substation needs to safely move and manage electricity, Eaton gear is somewhere in the stack.
The aerospace business is a meaningful side business too. Fuel systems, hydraulics, and motion control for commercial and defense aircraft. High margin, long product cycles, good visibility. It's a real compounder inside the bigger compounder.
Market cap is around $155 billion. Trailing 12-month revenue is about $27.5 billion. And this is not a commodity business. Gross margins are around 37%, operating margins just over 19%.
Which are industrial peer-leading numbers. For context, pure industrial conglomerates typically run low to mid-teens operating margins. Eaton's mix has shifted toward higher-value electrical products, and margins have followed.
Let's talk leadership. As of June 2025, Paulo Ruiz Sternat is the new CEO. He took over from Craig Arnold, who retired after more than a decade running the company.
Ruiz Sternat is a 2-decade Eaton insider. He was running Electrical Americas, the fastest-growing piece of the business, before stepping up. So this is a promote-from-within succession, and the job is continuity, not reinvention.
He has a reputation as an operator. Quiet, disciplined, customer-focused. Not the kind of CEO who does big Wall Street tours. He spent his career close to the factory and close to the customer. And that's what the board seemed to want.
Which makes sense because the strategic direction under Arnold was already working. When the prior CEO leaves the business firing on all cylinders, the new CEO's job is to not mess it up. So far, the initial tone from Ruiz Sternat has been exactly that. Steady hand, same playbook, keep executing.
All right, time for the numbers. Let's walk through valuation, growth, profitability, and the balance sheet. Start with where the stock trades.
Price is around $400, market cap around $155 billion. Trailing PE is in the high 30s, call it 38 times. Forward PE based on 2026 analyst estimates is around 26. Price to sales is roughly 5.7 times. Price to book is about 8 times.
Those are premium multiples for an industrial.
They are. Most industrial peers trade in the high teens to low 20s on forward earnings. Eaton commands a premium because the growth rate, margin profile, and end market exposure are genuinely better. But it is priced for quality.
Revenue growth, what does that look like right now?
Trailing 12-month revenue is up about 7 to 8% year over year. Within that, Electrical Americas is running double-digit organic growth, Electrical Global is mid-single digits, aerospace is high single-digit, and the vehicle business is basically flat to slightly down because of weakness in commercial trucks and powertrain.
The mix is doing the heavy lifting. Electrical Americas is the biggest segment and the fastest growing one. That's a beautiful setup.
It is, and the forward estimates look strong. Analysts have revenue climbing from roughly $27 billion today to something like $33 to $34 billion by 2027 and north of $40 billion by 2029. EPS is projected to grow from the low teens today to over $20 by 2029.
Profitability. Where are margins sitting?
Gross margin about 37.6% trailing, operating margin about 19.1%, net margin about 14.9%. Those are all at or near the high end of where Eaton has ever been, and management has guided for another leg of incremental margin as volume scales.
Cash generation. I always care about this one.
Operating cash flow trailing is about $4.5 billion. Free cash flow is very close to that. Eaton is not capital intensive the way a chip maker or a pipeline is. Free cash flow yield on market cap is around 2.9%, which is modest because the valuation is expanded.
Balance sheet.
Total debt is about $11 billion, cash is roughly $600 million, net debt around $10.5 billion, total assets $41 billion, equity $19 billion, net debt to EBITDA runs around 1.2 times. The current ratio is 1.3, quick ratio 0.8. It's investment grade BBB plus territory with plenty of capacity for buybacks, dividends, and bolt-on M&A.
Capital returns.
Dividend yield is about 1%. Payout ratio around 32%. So there's room to keep growing it. The dividend has grown every year for over a decade. Buybacks are opportunistic. They've been repurchasing stock but not aggressively.
Health verdict.
Financially, this is an A-grade balance sheet. Strong cash generation, moderate leverage, high-quality earnings. The valuation is the only thing that keeps it from being a no-brainer. You're paying up for all of that.
Let's talk Wall Street. What does the street think?
Coverage is deep. Roughly 27 analysts covering the name. The consensus is a lean buy, but there's a meaningful hold contingent. Price targets cluster in the 420 to 440 range, which implies maybe 5 to 10% upside from current levels.
Which tells you what?
It tells you the street agrees Eaton is a high-quality compounder, but is cautious about adding much above here. When consensus targets only imply single-digit upside, you're not getting a lot of help from Wall Street if things go wrong.
Recent analyst actions?
Barclays and Wells Fargo both sit at equal weight as of April. Evercore ISI is in line. A few firms have trimmed price targets modestly this year despite earnings beats, which is a tell. Analysts are wary of valuation more than fundamentals.
And last earnings print?
Q4 2025 printed in early February. EPS was 3.33 on a 3.31 estimate, a small beat. Revenue was $7.5 billion on $7.09 billion expected, a slight miss on the top line. Mixed quarter, but the order book commentary was strong, which is what sent the stock up on the print.
When's the next earnings date?
Q1 2026 results are expected May 1st. Consensus EPS is around 2.75, revenue around $7.1 billion. The stock typically trades on orders and backlog commentary, not just the headline numbers.
Okay, bull case. You said I could have this one. Here's why I like Eaton from here.
Go.
First, the data center story is real and it's not close to done. Hyperscalers are building gigawatt-scale campuses. The electrical architecture for a single data center is a multi-hundred-million-dollar spend, and Eaton is specified in deep.
Fair. And it's not just the big three hyperscalers, it's colos, AI-native builders, and sovereign data center projects in places like the Middle East. The demand is geographically broad.
Second, the U.S. electrical grid is the oldest it's ever been, and it's getting overwhelmed by electrification, data center load, and renewables interconnection. That's decades of catch-up investment by utilities, and Eaton sells right into that spend.
Utility capex has been quietly inflecting higher for 4 years and is projected to keep doing so. Agree.
Third, aerospace is quietly crushing it. Commercial aerospace recovery plus defense strength drives high single-digit organic growth with strong margins. It's underappreciated.
It's real, though it's smaller than electrical.
Fourth, margins keep expanding. Management has been really disciplined on pricing and mix, and incremental operating margin is in the 30s. Every dollar of incremental revenue is flowing through at very attractive rates.
And fifth,
balance sheet optionality, $4.5 billion in free cash flow, moderate leverage. They can return capital, do bolt-on M&A, or just compound. I like that flexibility in any macro environment.
Okay, bear case. Let me make you uncomfortable.
Go for it.
Number 1, valuation. At 38 times trailing and 26 times forward, you are paying a premium to pretty much every industrial peer. If growth merely meets expectations instead of beating them, multiple compression alone can produce a flat to negative return.
Ouch, but fair.
Number 2, data center concentration cuts both ways. If hyperscaler capex slows, whether because of AI ROI questions, power bottlenecks, or a broader macro softening, the whole growth algorithm resets, and that would hit order intake, not just revenue.
The orders would slow before the revenue. That's a real vulnerability.
Number 3, input cost exposure. Copper, aluminum, steel, electronics, all relevant. Tariff policy uncertainty, trade disputes, supply chain disruption, any of those can squeeze margins without much notice.
Number 4,
Shares are near an all-time high after a massive 2-year run. That's the kind of setup where any earnings disappointment triggers an outsized move lower. The risk-reward is asymmetric in the wrong direction from here.
and 5,
International exposure. Electrical Global and Vehicle both have meaningful exposure to Europe and China. If industrial activity abroad slows further, that's a drag that can offset U.S. strength.
sobering list. Let's look at peers.
Best industrial comps. Emerson Electric trades at about 29 times earnings and 4.5 times sales, growing revenue in the mid-single digits. Honeywell is around 27 times earnings and 3.7 times sales, growing around 5%. Cummins is cheaper, 16 times earnings, 2.5 times sales, but revenue is flat to down.
So Eaton is the priciest of the group.
Correct, but also the fastest growing, with the best margin profile, and the most concentrated exposure to the 3 big secular themes we talked about. You're paying for quality and end market mix.
That's the trade. Options activity, anything unusual?
Nothing screaming. Call volume has been modestly ahead of put volume around earnings. Implied vol is compressed because the stock has been grinding higher steadily, and open interest clusters at the 400 and 420 strikes. This is a name the market treats as a quality compounder, not a speculative vehicle.
Insider activity?
Typical large cap pattern, mostly option exercises and program sales. No meaningful open market insider buying, which you rarely see at a company this size anyway. Nothing that tells you anything directional.
Risks to watch going forward.
3 things. 1. Q1 results on May 1. Watch Electrical America's orders and backlog commentary. 2. Any hyperscaler CapEx guide cut from Microsoft, Amazon, Google, or Meta would directly read across. 3. Tariff news. Industrial equipment has input exposure, and policy uncertainty could show up in Q2 margins.
Catalysts on the upside?
A big order announcement, either a hyperscaler framework deal or a utility mega project, would probably move the stock. Incremental grid investment policy from Washington or state public utility commissions, an execution that continues to deliver order growth above 15% in the electrical segments.
Okay, bottom line, one paragraph.
Eaton is one of the cleanest pure-play beneficiaries of AI infrastructure, grid modernization, and electrification. Margins are great, cash generation is strong, balance sheet is in good shape, and Electrical America's backlog gives multi-year visibility. But the stock is trading at a premium valuation after a massive run. At 26 times forward, you need execution to keep being flawless. The thesis is not broken, it is priced. Anyone buying here is effectively saying the next leg of the secular story is bigger than the market currently believes.
Key metric to watch?
Electrical America's orders growth. If that stays above 15% year over year, the thesis stays alive. If it decelerates below 10, multiple compression becomes a real risk.
Closing thought. General Norman Schwarzkopf once said, "Leadership is a potent combination of strategy and character. But if you must be without one, be without the strategy."
Appropriate. Eaton's just handed the wheel to a new CEO. Strategy looks the same. The question is whether the character to execute is still there. Early signs say yes.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Thanks for listening to Charged Alpha. Until next time.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.